Friends, here we go, the second session. It's on private companies. As I had given you a primer in the morning, there's enough and more of headaches when we are going to deal with our existing private limited companies. Maybe one of the statistics says that there has been a 75% drop in the number of companies being incorporated since 1st April 2014. The government is also getting alarmed. Not that there is any revenue loss or anything for them, but what is more significant, having brought in a concept of 1% company and wanting most of them to get transited into a corporate structure where there will be fair amount of control, if they find even private companies are not going to come and more is going to be either an LLP or much less of an LLP, partnership firms, the whole purpose of bringing in this new legislation may possibly not see the effect of it. To deal on this very important topic, we have with us Sripriya Kumar from Chennai, a product of PricewaterhouseCoopers, and a person who got elected to the regional council with a thumping 1556 votes in the first count, has vindicated the faith of each one who has voted in her favor by taking up a lot of very useful and important initiatives in the regional council. Foremost of that, I consider, is standing up in the council and raising voice and concern where it matters most. This has been an attribute very less seen in the council, and I have the greatest of pleasure and privilege in telling you all that she has stood up for the right reasons at all times. Not only that, she has, to her credit, reached out to every member at their desktops at their convenience to look at topics of interest and importance for our members to update, like what we are doing today at your convenience by reaching out to on the knowledge series called as Companies Act Update, which as of yesterday 71 updates have come. It's a great degree of effort from her. I'm sure that people here would like to appreciate it with a round of applause for this. She has also done a lot of other work, like giving the templates, the program charts, the structures of how we will have to document, the audit plan, the methodologies, the practice kits, the tax audit programs, and so much more as content to the members by her regular updates on various fields. She is an extremely avid blogger and possibly gets the maximum amount of likes in her FB page. She has, to her credit, that been a speaker on various topics of importance, and especially I would say that I have personally seen her go through the Companies Act, dissecting it section by section of what it was earlier, what it is now, what it portends in terms of the grave dangers it warrants for the profession, and how to address that. And she has taken very keen interest. In making representations to the institute as well as to the bodies, like signing certain petitions of importance, like section 234E, like including the siphon when it was to be increased, or when the valuation of the papers had to be done, and the institute was looking at increasing it to 5,000, 8,000 and all. She gave a clarion call to come out to say that what is to be done and how it is to be done, and putting in place views of the members and students very firmly to the authorities. Of course, I can read her biodata, which she has been an extremely bright student, having charted out a lot of things, and professionally she has been a partner of a firm, SPR and Company, a gender diverse firm where there are about 8 of them, out of which 7 are women, possibly the only firm in the country which has got this sort of a pedigree. They are into very high-end consulting on internal audits, okay, and beyond that, she is a very humane person, very easy of approach, and interacts with everybody to such a way whatever best is possible to be given by her, she is always at hand to give it. With this brief introduction of her, I would like to request Sripriya Kumar to take over this session, and much before that, I have a pleasure in asking Mr. Ravi Prasad to come over and hand over a bouquet to Sripriya Madam. Just before you start, she is a ranker in her school, and her CA examinations, she has done it possibly with the left hand, and this is the Sripriya Kumar who is going to take up through the Companies Act the aspects of the private limited companies. I have also requested her to briefly touch upon the Cabinet Committee's recommendations which has gone for consideration by the Lok Sabha, which she will be touching upon briefly. Over to Sripriya.
The Chairman of the Bangalore branch, C.A. Babu Devar, CAPR Suresh, the members of the branch managing committee, some friends I have in Bangalore, and ladies and gentlemen, here's a very hearty good morning to all of you. At the outset, I'm extremely thankful to the Bangalore branch for having given me this opportunity to be here today to present before you on private limited companies. And I'm also very, very thankful to CAPR Suresh, who's been a man of remarkable resilience, for these very kind words of introduction. There are only two things about this introduction. I still haven't learned how to look when you're getting introduced. And the second thing is about my knowledge updates. In all humility, I must say that I have been the biggest gainer. So I've managed to learn something every day, and I'm very, very thankful for this council role just for that one great reason. With the exception of the Hammurabi's Code of Law, the Manu Smriti, and the Arthashastra perhaps, like Kautilya, there have been very few legislations in world history which have been proactive. Most laws, rules, codes, however you call them, have often been the response of a government to a civil society's behavior. And I don't think this Companies Act is any exception. It's a very, very reactive, regressive, punitive in some parts legislation that seeks to rein in corporate India for a stream of successive failures that we've seen both in the private and in the public sectors. In some sense, it was India's response to corporate misbehavior. While the US was very, very quick to respond with the Sarbanes-Oxley, India took a very, very long time from 1992 to now coming to 2011 to actually enact this new law. Much has been said and spoken about this law. According to me, I think it's a good piece of legislation, especially for chartered accountants. And if we play our role strictly as being chartered accountants, then I think this act presents a whole lot of opportunity, not in terms just of professional opportunity, but learning as well. I intend to make my presentation in 2-3 parts. Part A, the latest to hit us on this Companies Act, is the amendment bill which has been tabled day before yesterday. It's got 14 important, or what they believe are important aspects which have been taken up for consideration. So I will quickly run you through those aspects just so that you're in tune with this Companies Act and where we are heading. Part 2, I will try and extensively focus on some 20 important things about private limited companies. So this is going to be the structure of my presentation, and if you have any questions, you can either do that in the middle or towards the end of the presentation or the end of the part as you feel free. What was the need for a brand new act? Large scams in India had exposed significant weaknesses. There are a lot of view that says, no, this act has looked at every management as a criminal and every auditor as an abettor. Now, I, for one, have noticed that every significant amendment to the Companies Act 1956 seems to have a story behind it. I'll give you a small example. Today, the Companies Act says if there is a share application money that's pending allotment for more than 60 days, it needs to be classified as deposits. And this pretty much applies to private limited companies as well. So somebody said, why should it be done? Which is when I actually read something which said there is a company, a private company of a very large group in India where the authorized, the share capital was 2 crores and the share application money pending allotment for years was in the region of 450 crores. See, unless the money hits the share capital or gets repaid, it doesn't come in any radar. So it's very effectively used to park funds which people, obviously the government didn't like. Similarly, today investment companies have a restriction. You cannot have more than 2 layers of subsidiaries for investment companies. There was a scam called the Purti scam, and they're still trying to figure out where the money originated. So each failure, somebody has attempted to tighten it, but we'll have to wait and watch whether this act will be government or governance only for one reason. The penalties under this act have been heavily slabbed, which is a huge disadvantage. You take a 234E, it's you live or you die by that 200. Here every penalty starts from 50,000 to 5 lakhs, 5 lakhs to 25 lakhs. And who's going to take the call on it? A government official sitting in a certain office, and India doesn't really rank very high on the corruption index, so one really doesn't know. I think this will be the challenge in this law, which will be an opportunity. Very quickly, this is how corporate governance in India happened. We started in 1998, much after 92, the Harshad Mehta scam, moved up, and then finally we've reached the New Companies Act 2013. One significant dimension to this corporate governance story was actually the Clause 49 introduction. However, a lot of controls were only imposed on listed companies, a little bit on public companies, and very little or nil on private limited companies, and this scenario is decisively set to change with the Companies Act 2013. This act, forget the noun, it's a complete verb. When in doubt, remember 3 words: accountability, corporate trusteeship, transparency. So anything where you have a scenario to apply, you can make sure that this act is in this favor. If you're looking for a particular provision, you can safely tell the client not to do it because it's going to be in the negative, or it's going to prescribe a higher degree of accountability or transparency. The funny thing about this act is that it's yet to be enacted completely. The first of its legislation in a long while now, and this act has seen, as of the last month when I did this update, 36 circulars, 16 notifications, 7 removal of difficulty orders, which is very surprising under section 470. There's been a draft notification which has been issued on June 24th. Now, whenever you're advising a private limited company, this draft notification is seminal. These are the changes that we think will happen over a period of time, and if you look at it, as of today, we've already finished 2 quarters and we're close to finishing the year. So private limited companies continue to be in a state of suspended animation thanks to this draft notification. We are neither able to move forward nor are we be able to advise our clients confidently to go backward. And of course, the last of it is the amendment bill which has been tabled very, very recently. These are the 14 aspects of the amendment bill: omitting the requirement for minimum paid up capital, academic, ease of doing business, common seal optional, ease of doing business, prescribing specific punishment for deposits. Well, this was one section that left everybody very, very surprised, because as compared to the earlier act which had prescribed imprisonment for defaults in deposits, repayment or interest thereon, this act was silent on imprisonment and only spoke of corporate level penalties where your capital reduction would get affected, your dividend distribution would get affected, your buyback would get affected. So now I think they're planning to bring back the imprisonment, prohibiting public inspection of board resolutions filed in the registry. This act specifies that certain categories of resolutions, such as major decisions, proposal to buy somebody, proposal to acquire somebody, those board resolutions which have to be ideally filed with the registrar. Now this would only reduce the board transparency because these decisions finally will not get documented. The other question that was left open in this Companies Act is, some of this qualifies to be price sensitive information. In that context, how right or appropriate is it for us to file it to an MCA, which is actually a body that comes under RTI? There is an inclusion of provision for writing off past losses and depreciation before declaring dividend, which was omitted earlier. They no longer appear to want us to transfer equity shares. Only the unclaimed dividend, to prevent misuse, they said you have to transfer it to the Investor Education and Protection Fund. Then they spoke of having to transfer the shares. I'm told this runs into hundreds if not thousands of crores in India. Unclaimed dividend and the parent shares to which they relate to. It now appears that the shares don't have to be transferred, enabling provisions beyond which fraud shall be reported. Now this act very funnily had a certain section called 143(12) which says auditors have to report frauds. To whom? To the ministry in a certain format, ADT 4. And where he had reason to believe or suspect there was a fraud, it had to be done. There's a very interesting story to this. When the draft rules came, they had defined fraud to be at a certain threshold of 2% of turnover, 5% of profits, or any fraud occurring regularly. So it appears that a lot of people went and asked them a lot of questions on what is this occurring regularly, is an IP theft, how do you treat? So they said in the next set of rules there was no mention about this materiality at all. So the act which finally got enacted came without any reference to what is the value threshold for a fraud, and it was extremely piquant in the sense that this fraud provision was imposed on the audit fraternity, and I'm just hoping this has gone out completely because of the following reasons. See, the parent definition for fraud was section 447. That section was not notified. Incidentally, out of the 470 sections of this act, as we speak today, only 283 are notified. So 447 was not notified. Second, look at a KMP, Key Managerial Personnel. Only public companies above 10 crores of capital need a KMP. So you don't even have a KMP, but an auditor has to report a fraud. 3, you don't have an independent board in most companies. Only certain categories of companies need to have independent directors. So it's husband and wife shareholder, husband and wife are the directors, and you're still required to report a fraud. So you have many criteria which were not. Internal audit is not mandatory for most private companies unless they reach a certain threshold. But as an auditor you still had to report fraud. Vigilance mechanism. You had a whistleblower. I had read one of these research reports that said that the biggest possibility of detecting a fraud was if you have whistleblower, and the least possibility was a statutory audit. So how could the government have just come up with something completely out of the box and said we don't have a basic fraud control framework, but an auditor would still have to report a fraud? Fine, it was fine to report, but what was the penalty for non-reporting? It was between 5 and 25 lakhs, and I hope this is amended. I speak slightly extended on this particular provision because I'm absolutely passionate about it, and a lot of us who audit clients who have bank fundings, end-use monitoring has been a continuous issue on which we don't comment anywhere, and neither do the banks bother. But tomorrow if there's a fraud due to end-use monitoring, will that cast a reporting responsibility on the auditor? Because here you will be guilty unless you prove, and then we have layers of civil, criminal, institute, DC. May not take us very far. The next is an exemption under section 185. This was a sort of a drafting error, it appears. Loans to directors under this act is completely prohibited. It's not allowed. Loan to a director or a company or a firm, whatever, or a body corporate in which he is interested, not allowed. Not allowed for all companies. Now, the erstwhile section for this, which was 295, gave exemption from a holding to a subsidiary. That got omitted in the act. So as an afterthought they brought it into the rules, and they said any loan given by a holding to a wholly owned subsidiary is exempt, and a guarantee provided by the holding to a subsidiary for the purpose of a borrowing from a financial institution is exempt. Now, since this was, and again this is another very funny act, because you've got rules which extend beyond the act. What's not there in the act is there in the rule, and this was one such exemption that is now sought to be brought back into the act, purely a correction. Empowering audit committee to give omnibus approvals for related party transactions. At least in these amendments, one thing is very clear. The big boys have squealed really hard, because it's practically not possible to have so many levels of controls on related party transactions, especially when they are large companies and it would have gone into a tizzy. So they've relaxed on section 188, it appears. And the other three are fairly procedural exemptions. Bail restrictions will apply only for fraud relating to 447. Other cases it's not non-bailable. I think this basic understanding of this act is a little bit relevant for us to proceed further. I think there are 5 things about this Act which are very, very important. One, this Act aims at a one-place enshrinement. I'll give you a few examples. You just finished a session on depreciation and you must have discussed about componentization. Componentization is there in IFRS but was not there in the Indian scenario, in the Indian Companies Act scenario. Now we've brought componentization in. Consolidated financial statements. 3. Previously the SEBI Act prescribed penalties for insider trading and sharing price sensitive information, forward dealing. That's now come into this Act. So you will notice that a lot of things which were present in other laws and regulations have been attempted to be consolidated here. For example, private placement. There's really nothing documented, but now it's sort of come in firmly here. 2, it's notified in parts, tentative, transitionary provisions are not clear. Now this Act is going to be a nightmare for your 2014-15 accounts. A lot of the provisions, except some parts of depreciation, this componentization deferral, in fact componentization is compulsory from next year. 95% of the notified sections are applicable for this Act, and there has been a complete lack of clarity on transitionary provisions. To the best of my knowledge, for independent directors they are clear. Thankfully for auditors rotation, they are clear on transitionary provisions. On the remaining parts, we have clarifications, we need to await clarifications. See, again, there is a certain view that you can take here. I'll give you another small example. Look at share application money pending allotment. This is something a lot of our clients may have. Technically, share application monies received under the previous Act, if you don't allot it within 60 days, it cannot be classified as a deposit. And I have 2 reasons. Again, this is a completely personal view based on a certain understanding and reading, may not reflect the spirit of the Act. Because the rules for this particular deposit says, deposit means any sum of money received under this Act. So it is not the earlier Act. And 2, there is a certain section which allows for acts performed in good faith or under the erstwhile Act. It's one of the early sections, comes somewhere between 5 and 10. It's for the same reason today that you are not amending your articles or memorandum of association. Ideally, you will have to move to the new table format, which you are not doing, primarily because an Act done under the earlier Act, as per that, guidance still holds good. So transitionary provisions across all your balance sheet components, fixed assets, your depreciation, investments, subsidiary layering, there is no transitionary provision there, but we'll have to wait and watch. Inventories, I can't think of any, but going forward on your deposits, your loans and advances, there are significant changes. For example, if your client has given or obtained an advance from a supplier and he has not adjusted within 365 days, that needs to be classified as a deposit. So I'll discuss this in later detail, but yes, transitionary provisions, you may have to go through every component of the balance sheet and check if there's something that's impacting any of these sections, and you'll have to take it forward from there. The other thing is, this is a rule-driven legislation, so be rest assured that it's going to keep changing. I'm told that in about 338 places in this Act, it says, and rules as may be prescribed. As I had mentioned before, we have rules flowing from the Act, we have rules flowing independently. For example, you take prospectus, it may not be very relevant here, but they say any contracts with promoters needs to be disclosed. I don't think there's a reference to it in the Act, or criminal cases pending against promoters. I noticed a couple of things where there is no clause in the Act, but it's incorporated in the rule, and it actually makes this Act extremely complex to administer, and it keeps changing, which is why I think it's a professional opportunity. And today it's very nice that you have this program here today, because you have an early mover advantage if you've managed to master this Act. Threshold based compliances. This is another enormous change in this Act. The previous Act was very clear. You had a listed company, you had a public company, you had a private company. Now let me try and explain the landscape of this Act to you. Now in the previous Act, a particular section would apply or not apply depending on which category you came under. Now this Act is different. visualize multiple axes. I haven't actually done it in a presentation, but I'll try and explain this to you. On one axis, you have public, private, listed, one-person companies, small companies, dormant companies. Then you have another box where you have financial thresholds, which could be share capital, it can be turnover, it can be deposits, it can be deposits plus borrowings, it can be borrowings, it could be net profit, or any combinations thereof. Sorry? Yeah, net worth, share capital. Yeah, share capital is there. Then you have another third box, which is your value thresholds. You have 50 lakhs, 2 crores, 5 crores, 25 crores, 50 crores, 100 crores, 500 crores, 1000 crores. So today, applicability or otherwise of a particular section would have come within this. Now, as if to complicate our lives a little more, this private limited company notification that I had mentioned, which came out on June 24th, which is in draft, attempts one more classification. It says a private limited company with less than 50 members and a private limited company with more than 50 members. So, and it appears this is going to be endless. It depends on, it's like the squeaky wheel gets the oil. Somebody goes and complains and says, okay, we'll give you exemption for this category. This is obviously attempted to help the existing private limited companies where the maximum is 50. So if you're a small private company, they want to give it to you. Then why have another small company definition? So this is according to me something, in terms of one person had described the visualization very well. He said maybe they just took the old act and gave it to 10 teams and said you'd redraft. So each one came with what thresholds there are, because these numbers don't seem to be too researched. For example, they speak of a woman director. Now, I don't understand why a woman director is not mandatory for a company which has a borrowing threshold. It's not mentioned. So it's like it's as good as anybody's guess. And the last of it, I think, very relevant about this act is that it's a completely new regime for private limited companies. And from this point onwards, I'll go into the salient aspects that govern private limited companies. We'll start from the basic. This act defines a private limited company under section 268. Now another very good thing about this act is they've made the definition section very exhaustive. I think about 90-91 definitions. So 98. Under the previous act, what was in 313 has been now moved to 268. It says a private limited company should have a minimum share capital of 1 lakh or such higher paid up capital as may be prescribed, and which by its articles restricts the right to transfer shares, limits the number of members to 200, prohibits any invitation to the public to subscribe for the shares of any company. Can somebody tell me what is the difference between this and the earlier definition? Just one key difference. Forget the numbers. One more parameter was there in 313 earlier. Yeah, you can't invite deposits from the public. Now, that has been moved to section, that restriction still stays. But that has been moved to section 73 of this act, which says that a private limited company can accept deposits only from members, and only certain categories of public companies with a certain threshold can get deposits from non-members. So, the restriction on accepting deposits only from its members stays. It's only moved to section 73. Otherwise, fundamentally the definition is the same. Now in this, it restricts the number of members to 200, but as per the rules, it's 100. But if you notice, this particular section doesn't have a rule reference. Now when we talk of exemptions, I'm not necessarily going to speak in these buckets, but you'll need to understand three things. One, those exemptions which were there earlier, where the section itself has gone, so not really relevant to you. Two, an exemption existing earlier, which continues. Three, an exemption which was there which is withdrawn. And 4, I think this is a relevant one, where you will think that on the basis of a legacy law from 1956 to now, that I don't think this will apply to a private company. So that's not the case. You have unusual provisions which seem to have been extended to private limited companies, which I think will be your biggest challenge. Because earlier, if you knew there was no restriction on directorship for private company, you will automatically go see here today. I mean, is there a restriction on number of directorships? Oh yeah, private limited companies are covered or whatever. Similarly, but there are some absolutely unusual provisions which you would normally not relate to a private company, which applies today to a private company. I'll try and focus on all of these in some order, in some logical order, but not necessarily in these buckets. A draft notification was issued by MCA on 24th June, something I'll keep coming back to. We need to know whether this will get amended or not. But one would imagine that if they had taken the pains to do such a big notification, why would it not, see the light of the day? Again, this act has a very interesting antecedent, a precedent to it. Apparently, this is one of the few acts that went to a joint parliamentary committee for review and came back again and went through another level of debate and changes. So, you can't rule out that this notification may not even happen. So, it's better to exercise caution. We spoke about this. Previously, the exemptions were private, public, listed. Now, it's listed, unlisted, OPC, small, dormant, thresholds based on share capital turnover, and private and public companies. I'd like to show you a small table. See, this I've only picked up an illustration of about 10 key sections. You might want to do more of this. For example, you take acceptance of deposits from the public. It's applicable to all public companies only. Only a public company can accept deposits from the public. Paid up share capital, there is no restriction. Total share capital, no restriction. But the turnover should be 500 crores or more. And the condition is or. That's the other thing. When we spoke of those different levels of thresholds, in some cases they have specified and, but in most cases they have specified or. For example, your CSR provision is 500 crores share capital or 1000 crores of turnover or 5 crores of net profit. So it's an or condition. So here you see 500 crores, 100 crores or more of net worth, and should have obtained the prior consent of the company in a general meeting. So today, whatever you take, for example, you go into internal audit. What are the categories of companies which are required to appoint an internal auditor? All listed companies. You go to the row number 3, or public companies which meet this threshold of 50 crores or more of paid up capital, 200 crores of turnover, borrowings from banks and financial institutions exceeding 100 crores at any point in time. This is the other challenge for your 14-15 implementation. So today if your client is anywhere between 85 crores or whatever, some number, if there is a interest debit and their loan goes up, or there is a commitment charge, but very unlikely at these volumes, but try and exercise caution. So this is how you read thresholds under this act. It's becoming very, very relevant. And the important thing is these thresholds have not been specified in the act. They come in the rules, which means it will keep changing. Please open the MCA website every day, because every day there's something new happening. In fact, the last time I saw, I could not locate all the circulars and notifications because they changed the format. So I spent about an hour trying to find it. Yeah. So getting back to the actual structure, which I'll do for the next maybe 45-50 minutes or so. Maximum number of members, 200 as per the Act, 100 as per the present rules, erstwhile 50. Private company today can convert into an OPC. Obviously, because they've created an OPC, a private limited company has an option to change into an OPC. Again, they've defined an OPC up to 50 lakhs capital and 2 crores turnover. So what happens if a private limited company converts itself into an OPC and then the turnover goes up? You will have to reconvert back into a private. We'll have to wait and watch whether anyone would take OPCs in India for such low value thresholds. An interesting aspect of this act, this is what I was talking about, is unusual provisions. Entrenchment provisions in the Articles of Association. What's a special resolution in any company? What's the percentage? 75. So what happens when you have two shareholders, one who's 80 and one who's 20? And if the majority shareholder proposes a resolution, it will automatically go through. Unless, of course, there are covenants in the share purchase agreement and the business agreement. So today the Companies Act provides for a very specific clause called entrenchment, which says you can create in your articles more restrictive covenants than the Act for aspects that you feel fit. For example, I can say in my company, in my articles, my special resolution will be 82%. So these are essentially aspects that I think have been done to favor the minority. And in terms of a very small digression, I think who is this Act really good for? It's very good for minority, it's very good for depositors, and it's very, very good for bankers. And I think it's good for auditors as well. Commencement of business. Previously there were no restrictions. Once you obtain your certificate of registration, you can commence business. There's again a story to this provision. Now the new provision says you will have to go and file your registered office with the registrar along with a proof. Apparently there were 1,10,000 vanishing companies in India. There are. I read somewhere, which means you don't even know where the company is, who's there, has anybody lost, has anybody gained. So, and some of these could even be bank borrowers. So today they said, regardless of who you are, we'd like to understand your address. And very closely related, which comes later in this presentation, is the requirement for one director to be mandatorily resident in India for 182 days. Again, if you notice, this Act came up with a very funny clarification on this. They said 182 days for from the date of commencement, you please prorate for this year. It's completely funny. So they said if you new company, then this particular period will apply. Uniform financial year. This Act says uniform for everybody. No choice of November to October, January to December anymore. Everybody is required to have their financial year from April to March. Only concessions provided for companies which have holding or subsidiaries abroad, and there is a need to align your financial statement with theirs. Today, all accounts have to be 12 months or shorter, and the only set of companies where you can have 15 months is where a company has been incorporated, let's say on January 1, 2015. Only for those companies they say don't close in March, you can close next March. So anybody who is, for example, if I've created a company in November, I'll have to close by March. The uniform financial year, the transitionary provision is very clear. They've given us 2 years to align. So it's safe. You don't have to knee jerk on this. Although I have seen some listed companies who've already gone in for this change. Cash flow statements. Cash flow statements are required. Previously we were not doing it, except for small companies, dormant companies and OPCs. See, in this, maybe 90% of the companies in India incidentally are private limited, and in this I do not have a profiling on small companies. Small companies are those companies which have a 2 crore to 20 crore turnover threshold or a 50 lakhs to 5 crore capital threshold. Now they have not specified a number within that. So what is today happening is, your small company starts where your OPC threshold ends. OPC is up to 50 lakhs of capital. Small companies 50 lakhs to 5 crores of capital. Turnover similarly, OPC stopped at 2 crores. Here it is 2 crores to 20 crores. It's classified as a small company. So it's which means today any company under 2 crores or 50 lakhs is anyway small. Similarly, any company with less than 2 crores of turnover is anyway small. So you don't have to bother. Books in electronic form. Today you can maintain your books in electronic form. It's been mandated to be maintained in electronic form only for certain larger companies. Consolidated financial statements. This is today compulsory for private limited companies also. Very simplistically put, if you have any other company in which you hold more than 20%, you will have to consolidate. Similar to your IFRS, some unanswered questions are there. So which means today JVs where you hold more than 20%, you will have an issue of whether LLPs have to be consolidated. Because today the Act speaks of body corporates and LLP is a body corporate under this Act. So if you have a private limited company which holds in an LLP, would it become relevant? The LLPs are not hugely popular today, but as and when they do, well, whether these aspects would get included. I personally think this CFS is a huge opportunity. CFS is not an opportunity so much for aggregating numbers, but in India, every company can have its own accounting policies. So this accounting policy synchronization will be the biggest challenge in CFS. I'm given to understand by Mr. Acharya, I didn't read this, that this consolidation is mandatory for 1450. Okay. So you don't have to consolidate. That's because there is also a difference between AS and what the Companies Act says. So there's also one level of synchronization that has to happen there, harmonization. Depreciation, Mr. Acharya would have, I'm sure, dealt with it extensively. The componentization has been given a break. One interesting thing that could happen, I don't know whether they'll figure this impact and then roll it back, is that it will affect MAT companies. My MAT payout will go down and certain companies could end up, because the rates today between IT and Companies Act are coming closer, there will be a revenue loss to the government on MAT account. And today, as he had also pointed out, this Act is silent on profit that comes. Suppose I have been depreciating at a lesser, for a lesser time frame and the Act today permits a higher. Can I take this opportunity to do a depreciation right back? Yeah, you can.
In the meantime, we welcome Mr. Joman George. I would request him to come on there.
The next is this provision on audit rotation, which I'm sure we're all familiar with. It says that individual for up to 5 years and a firm for up to 10 years unlimited tenure is possible. The good news is that they've given us a 3-year transitionary time. Now, while it was expected that private limited companies may be exempted from this rotation, it is not there in the notification. So today the only companies I think are dormant and OPCs are exempt from rotation. 143.12, we dealt with this on fraud reporting. Even if it's a private company and you come across a fraud, as of today, you have to report the fraud in Form ADT 4. And fraud here is frauds against the company committed by the management. It's not third-party frauds against the company. So that they have, it's because that is the 447 definition of fraud. It's an act which is intended to deceive or gain, whether there is any wrongful gain or not. So that is the slightly scary part about this act. So today if I prefer a particular supplier at the same price and get a kickback, then would those categories of frauds have to be reported? You will have to investigate, because procurement frauds are the most common everywhere in the world. So you will need to handle this a bit carefully. Of course, they specify for fraud reporting that you have to first intimate the board 60 days, give them time. If they don't respond, then within 15 days you have a responsibility to report. Now there has been one very interesting question. Getting a management representation letter at the end of your audit, will it sort of protect you against this fraud reporting? The answer is a very, very clear no, because representation letters do not help in assertions of genuineness. They help you on other assertions such as occurrence, valuation, allocation, proper period, but not, it will even satisfy rights and obligations, but not on genuineness. So this will remain an incumbent responsibility of the auditor only. I will towards the last part of my presentation tell you about another very, very high impact provision which is very closely related to this, and it's on internal financial controls over financial reporting, which again will apply for private limited companies as well. Auditors not to perform certain services Very important. It says directly or indirectly. You shall not perform other services which are in the nature of accounting, management advisory, internal audit. Now there seems to be some kind of a perspective emerging that tax representation is okay, but there is no clarification on this. And again, this act at the end of this section 144, it's called proscribed services in a general parlance. The last part of this section ends with the historical phrase, and such other services as may be prescribed, which means as they come up with more and more defects, they can keep enhancing this list. Now you have and here they say directly or indirectly, which means today if you end up doing accounting services and you raise one bill called audit, but if you have some mail trail where it can be proved that you've done an accounting service, you have a possibility. So the best thing is actually to work around it. This act also provides for a 1-year transitionary time frame, which means this must have mostly, I think this section got notified. By the way, this act got notified on 3 different dates. 98 sections implemented with effect from September 2013. 1 CSR came late 2013, I think February or March, and there was one which happened on April 1, 2014. This section I think was April 1, 2014, and for 2014-15 you don't have this restriction, but it's better to quit at the earliest and work an option. And here if you are a director in some other company and then that company is doing the accounting, all this please avoid. Keep it clean, don't engage. Appointment of internal auditors. See, this is something one would have logically thought, will it affect a private company? Yes, it does. It's compulsory for listed companies, private companies whose turnover is more than 200 crores or borrowings from banks / financial institutions exceed 100 crores or more are required to appoint an internal auditor. Now I have a very interesting view on this. I'm saying today, if the Companies Act can mandate a corporate borrower who has a bank exposure, why can't we actually speak to RBI and ensure that similar internal audits are mandated for all non-corporate borrowers with 5-10 crores of exposure? And I am sure these are decisions that even the RBI doesn't need to make, but if you do have relationships with chairmen or directors of banks, this will add tremendous value in terms of mitigating NPAs in the banking sector. Today, none of the large borrowers are going through an internal audit system other than CDR cases where a firm is appointed to do a complete review of the escrow account and how the funds are moving. I think this is a huge business opportunity in the non-corporate sector. Tremendous value add. Number of companies audit limit. They say a person or a partner can do only 20 companies. Private limited companies as of today are included in the limit, but the June 24th notification has proposed this exemption of private companies, but the amendment bill does not speak of this. Anyway, what we've gotten to see now is only the 14 salient aspects of the amendment bill. So I googled for it, but I couldn't find it. So maybe the moment it's tabled, you'll know whether these are there in some other parts. Because the press release only says only this 14 has been done. So we don't know whether it is also included. But for reasons of materiality, they took only the big amendments. Correct. They had only 2 days time. Okay. 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 And they are standalone clauses. Okay. But then they could have pretty much added it to this amendment bill, no? Okay. No, it was only a notification. Okay. Fine. So maybe, as I stand corrected, so I think that's a parallel track that's running. So maybe your June 24th notification will come through. Will go. Yeah. And interestingly, it's not really a business disabler. Nobody is stopping you from taking one more partner. Again, there's one more, in the aspect of proscribed services, when we spoke of one place enshrinement, this is another effort. One of the reasons the Enron and the other collapses happened was because the auditor was also the consultant, something that SOX sought to disable. Today, in the Chartered Accountants Act, of course, I think in 2002 or something, there was a very clear note that said, your non-audit revenue cannot exceed your audit revenue. Today, the Act has said you will not even have a single paisa of non-audit revenue. And more importantly, this Act today says, if a statutory auditor wants to do any other work, it has to be cleared by the board and the audit committee. So today, it's not that one GM Finance can appoint a statutory auditor to do a recon job. He has to get the consent of the board, and it's the statutory auditor's responsibility to make sure it's actually complied. Because if you end up doing a service, there is a penalty both on the auditor and on the company. Then we come to this capital raising in private companies. This Act today defines a private placement, largely to accommodate the growing PE and VC funds that are hitting India in a big way. Now, private company has basically an option to go for a private placement, where they say very simply, you can give a private placement to a group of members not exceeding 50. Of course, this qualified institutional borrowers and all are exempt from that 50. So, they say you issue a private placement offer letter, and within 60 days, please allot, else you refund the money. If you don't refund the money, it will get treated as a deposit. Only care and caution that they want you to take is, you should not have two parallel private placement offers running. Finish one, then do the other one. It's a procedure, and you have to file a certain set of returns on this private placement. So today, if somebody is coming in, you have an option to do a private placement to them. The second option, now there's an erstwhile clause in the Companies Act 1956 that spoke of a rights issue under section 81, and private limited companies were exempted from rights issue. They said, you can offer it to anybody insofar as you don't exceed the number of members of 50. Today, perhaps that they have increased that 50 to 200. They've gone back and said, if you do a rights issue, you will still have to offer it to the existing shareholders in the same ratio, and they have the right to relinquish, in which case you can offer it to somebody else. So today, ideally, you have two options. If somebody wants to become a member in a private company and you have to allot a share, you have two modes of doing it. One is a rights issue and the other is a private placement. Now, in fact, we were just starting to discuss on this. There would be other, today, normally when you get an investor into your company and you're divesting a certain portion of your share capital, it may not necessarily be at par. It will be at a premium. So in either, and this Act again says, any valuation, there's a chapter 27 which speaks of registered valuers. It says everything has to go through a registered valuer. So the share valuation also has to be done by a registered valuer. And who's a registered valuer? They've categorized two kinds of registered valuers, a financial valuer and a technical valuer. A technical valuer has to be an engineer or an architect coming from their respective institute of engineers or architects, and a financial valuer can only be a chartered accountant, a cost accountant, a company secretary, or one of these merchant banker who possesses the requisite qualifications. So today, when you're doing a share valuation, make sure it's documented and signed off at the time of placement. Voting rights, deposits from members. Today, private companies can take deposits from members. But the Act says, even if you take a deposit from your own member, you'll need to get a credit rating, you'll need to maintain a deposit insurance and a deposit redemption reserve. Now this deposit insurance, they had given a waiver until this year end, but for nothing else had they given a waiver. So today, imagine you will have to hold 15% of your deposits maturing this year and next year in a deposit redemption reserve, which means I can use only 70% of my funds. So it actually increases my cost of capital. So today it becomes a little unattractive, but these previously it never used to be treated this way. Now there is a challenge here. Today, if you have a share application money which is pending allotment, which gets classified as a deposit, then you have violated 73 because you have not got your credit rating, you have not done anything. So this is primarily because they wanted to make sure that people are accounting and returning for every money that they've brought into the company. Because if you look at a very tax view on this, for example, loans from directors. Today, loans from directors are not treated as deposits. But a loan from a director's relative, which was exempted under the previous act, is treated as a deposit under this act, even for a private limited company. So these are just some examples on how in every component of the balance sheet, even if you are a private limited company, you'll have to go through this. In fact, it's a very interesting thing. Why should, in fact, there is section 185 where we spoke of loans to directors. Ideally, there is no loss to anybody if a private limited company gives a loan to its directors, because your deemed dividend provisions may apply. Ideally, the government really did not have a locus standi to come into this at all. Husband and wife shareholder, husband and wife director, no bank borrowing. But still they had placed this restriction, which is why I think this restriction is being reviewed today. It's not necessary. Unadjusted advances, we spoke about this. Where you have received any advance towards the supply of goods, consideration for property under an agreement, long-term capital projects will not be treated as a deposit, only if it is appropriated within 365 days. Thank God they did not use the term repayment, which means today, if you close the agreement, pass a book entry and take a new one also, it is fine, not an issue. That's my view, because it only talks about an adjustment. It just doesn't talk of repayment. But the value should have been received. There's another interesting aspects that had emerged, but I think I'll keep that out. Whether an advance is a loan, whether advances will also get covered under section, the loans to directors, but those are all sort of not within this agenda and may take more time. Similarly, application money lying unadjusted needs to be allotted. I had told you the transitionary is still open. There are corporates which have taken a view that what I had received under the previous act, I will continue to hold, but you will keep on getting notices from the ROC. In fact, I know a company where there was a 2 rupee balance or something like that which was unadjusted. So they got a notice saying you've not adjusted this rounding amount. Loans from directors, private companies, very, very possible. Where you have a loan from a director, it says it will not be treated as a deposit if the director has given a declaration that it's out of his own funds. So as a matter of abundant caution, just make sure that you have this declaration with you. Directors stay in India, we spoke about it. This is a new one. If you're getting in a new director, he has to give a 1 lakh deposit. None of us would expect this, but this is applicable for a private limited company also. Again, there are two views on this. It says, if the board is empowered to nominate a director and it's present in the articles, my view is you don't need to do that 1 lakh. But generally, everybody seems to have taken a view that if somebody is standing for a director, please, somebody who is nominating him, or thankfully the director himself can give a 1 lakh deposit in favor of the company, and if he secures less than a certain percentage of votes, then the deposit gets forfeited. This is essentially to prevent frivolous attempts at directorships, especially in large companies. No, it is only for that period. No, I am nominating myself. The board meeting is 15 days down the line, 21 days. That, in fact, you can even give it on the day before it happens. It doesn't. No, I think the notice has to say that so and so is eligible for appointment and he has placed. So for that 21 days notice, you just need to. Appointment of directors, previously you didn't need to vote on it individually. See, these are very clearly corporate governance angles. They want you to cognize for each individual who is coming in as a director. Previously we used to say Mrs. X and Mrs. Y are retiring and they are eligible for appointment. Today when even the drafting will be A separately, B separately. Appointment of a director. There is a certain schedule in this Act, which is Schedule 5, which has got two parts to it. One is the appointment and the other is the remuneration. Your director, even for a private company, has to follow the conditions of Schedule 5. Previously, number and limit on directorships were not applicable to private limited companies. Today it applies. Limits on directorships, as per the Act, it is 20. Out of the 20, only 10 can be public. Now, if you look at a listed company, that's governed by SEBI, and SEBI with effect from October 1 has said only 7 listed companies, and especially if he is a whole-time director or a managing director in any company, it's restricted to 3. So there is also some amount of harmonization which they are trying to do with the SEBI guidelines, essentially on those related party transactions for which the amendment bill has been placed. Yeah, the central government approval is needed where there is a variance in appointment terms. As far as remuneration is concerned, where it's making profits, the Act is silent. Where you're making losses, the Act is specific. If you're a private company and if you're loss-making private company, your remuneration cannot exceed the amounts specified in Schedule 5 Part 2. There is a Section 1, Section 2 and Section 3. Section 2 and Section 3 you will have to read carefully. It says if your net worth is negative, it's only up to 30 lakhs. If there is a special resolution, then it can be doubled. So they've prescribed a specific slab. So today there is an attempt to control remuneration even in private limited companies. And no change is proposed on this. Board report on statutory compliance. Okay. This is an interesting one. There is a Section 134 which speaks of the board report. In that there is a subsection called 134.3. 134.3 speaks of the contents of the board report. In that, very interestingly, there are two inclusions. The previous ones I'll show you at the end of this. It was vanilla. The new ones basically speak of two things. Internal financial controls, only in the case of listed companies, but for all companies, today the board report is supposed to state that it actually says we have devised proper systems and procedures to ensure compliance with all applicable laws and regulations. The directors are supposed to state that. That applies to private limited companies as well. And I think this is a huge professional opportunity, because boards are not at all going to be comfortable making these statements unless there is an underlying comfort provided by somebody independent and competent. Independent, you can find any company also to provide it, but I think in terms of competence, we'd any day rank very high, because the bulk of these laws in India are either direct tax laws, indirect tax laws, labor laws and establishment laws. Establishment laws are like your Factories Act, your licenses, shops and establishments. Your direct we know, your indirect we know. So I think in terms of providing comfort, they might come back to us, and I think this will emerge as a huge professional opportunity, because these will be very checklist driven compliances that organizations will want to see before they sign off on these reports. Restrictions on powers of the board. Again, certain powers to be exercised by the company only with a consent and a special resolution, which is your erstwhile 293. Previously it was only applicable to private companies which were subsidiaries of public companies. Today it applies to everybody, but the exemption notification proposes to exempt companies with less than 50 members. But one good thing I have noticed in India is there are very few companies on that 49 threshold. I have never seen a private limited company with 49 shareholders. They are all pretty much under 10, 15, 20. So some of these are very academic in that sense. Is there anybody in this place who has, where you audited a private limited company with 49 shareholders or even 45, 48? Very rare. Disclosure of interest by a director. Today the Act says the Act says minority is the new majority. Very clear. So whether you are a director or a shareholder, if you are interested in something, you will have to stay out. Extending this to a shareholder is definitely wrong. It's it's not in the right spirit, because as a shareholder my objective is to maximize profit. By asking me to stay out of a resolution where I am interested, it doesn't do much for my commercial interest, and I think it's a very purist view of any legislation. But directors today, they are very clear. In the first board meeting where you come in, you will have to disclose your interest, or any time after that where you become interested in anything, you need to disclose it, and where they are discussing an agenda where you are interested, you have to stay out. This is applicable to a private limited company as well. Please envisage a situation where there are two, let's say a husband and wife company, husband and wife shareholders, husband and wife directors want to award a contract to wife's brother. How are we going to manage this? Additional directors, board enhancement, one has to think. Now the good news, sorry?
Rule 8 says, apart from the audited annual accounts and board's report, Rule 8 has added one more. Unaudited financial accounts shall also be considered by the board. You know, 41, clause 41 has been
clause 49 this is only for listed companies, or
I'm coming to that fact. I know this session is for private limited companies. 41 they have copied for under the board's power. Unaudited financial results also has been included by under the rule 8. My question is MGT 14. For all the powers which the board exercises, you know, MGT 14 gets uploaded. When unaudited financial statements are taken on record by a private limited company as a good corporate governance measure, where do I stand? Should I upload MGT 14 every quarter for unaudited financial statements where there is no resolution, which is just being taken on record?
If you are doing it as a matter of good practice and you are not required to do it, I don't think you should upload. If the law asks for it, I think we should comply, because another problem is, I hope I have understood your question right, otherwise I can take this question offline also, sir.
I'll just close it. Now, listed company requires under clause 41.
Correct.
But it doesn't say that, you know, it has to be audited.
Correct.
When listed company takes it on record, is it necessary for MGT 14? Only that's my question.
I'll come back to you, sir. If it's a listed company, then I'd like to look at it and I'll tell you. Yeah, I'll come back to you. I'm not very familiar with the form, so I need to just see the form and tell you. Loans to directors, they propose to exempt private limited companies completely from section 185, a welcome relief. RPTs, they're again proposing to exempt private limited companies. Essentially they're saying if a transaction is not at arm's length or in the ordinary course of business, you'll need to go for a board approval to get into it. Good practice. Essentially to prevent siphoning off of funds between related parties, which has been quite a significant challenge in India. Vigil mechanism. Again, one would imagine, you know, talk of a whistleblower sounds very, very high level of regulation. So one would logically assume, maybe it will be for a listed company or a public company. No, it's also needed for all companies which accept borrowings from banks or FIs which is more than 50 crores. So all big private limited companies will also have to have a whistleblower mechanism. There's a fairly well documented process. You need to have a website and you need to have an independent person sitting on it. Usually it's turning out to be the head of the internal audit or head of the audit committee. So vigil mechanism has been mandated now. CSR applicable where if you have a client who's a private limited company who's above 5 crores of turnover, 5 crores of net profit, then a 2% contribution becomes mandatory. So that's another separate thing by itself, whether it's the responsibility of the private sector at all, given that a lot of these should be ideally the responsibility of the state under your directive principles of the state policy of the Indian Constitution. Appointment of KMP. Now today private limited companies are not required to appoint KMPs, however it is rule driven. just public company with more than 10 crores capital needs to appoint a KMP. And who's a KMP? The CEO, CFO, CS, whole-time director, or whatever name called. So they have specified, given that I need to have an internal audit above a certain threshold, I need to have a visual mechanism under a certain threshold, it's only fair that the government considers KMPs even for private limited companies. And another very interesting reference on this fraud reporting is, if you notice, a chartered accountant who's an auditor is required to report a fraud, but the Act doesn't say that every CFO has to be a chartered accountant. I seriously believe he has to be a chartered accountant to be able to understand and appreciate this ever-changing context of regulation and controls. This is another one good reason why fraud reporting should not be made mandatory unless that is made mandatory. But of course, it's a view. And I come to the last part, which basically speaks of auditor's report. See, under the erstwhile auditor's report, which was your SA 700, the accounts, the controls were the primary responsibility of the management, and the auditor's responsibility was only to express an opinion on the financial statements. This management is responsible for the preparation of these financial statements that give a true and fair view of the financial position, the financial performance, and the cash flows of the company in accordance with the accounting standards referred to in 211(3)(c). And this responsibility includes the design, implementation and maintenance of internal controls relevant to the preparation of and presentation of financial statements that give a true and fair view and free from fraud and misstatements due to fraud and error. And what was the auditor's responsibility under the erstwhile Act and the erstwhile essay? Our responsibility is to express an opinion on these financial statements based on our audit. We conduct our audit in accordance with the essays of the ICAI, and we plan and perform the audit to obtain reasonable assurance whether the financial statements are free from material misstatement. The standard also speaks about performing procedures to obtain audit evidence. And in making those risk assessments, the auditor considers internal control. It only says the auditor considers internal control relevant to the company's presentation and fair presentation or preparation and presentation of financial statements, and to design audit procedures. So finally, as per the erstwhile Act, the erstwhile essay, expression of true and fair opinion with audit evidence, audit procedures was what was mandated. Now this, and it was very clearly the management's responsibility to prepare the financial statements and to ensure internal controls over reporting and financial statements. But now this Act is very different. See, there is section 134(3). This alone I'd like to sort of take a few minutes on this, because I think this is important, and this is presently pending with the institute. The auditor's report shall state, which is your 227 enquiries, whether he has basically whether he has sought all information and explanation. Okay, that is 143(1). This is 143(3). It says the auditor's report shall state whether he has sought all and obtained all information and explanation necessary for the audit, whether proper books of accounts as required by law have been maintained, whether branch returns have been obtained, whether the P&L and the balance sheet are in agreement with the books, whether the financial statements comply with the accounting standards, observation and comments of the auditors on the financial statements which have an adverse functioning of the company, director's disqualification, whether every qualification or adverse remark of the auditor has been properly responded to. And this is the inclusion now. This is a very significant and relevant inclusion, because you are now supposed to say in your audit report whether the company has adequate internal financial control system in place and the operating effectiveness of such controls. This is what I would like to call as the imposition of Indian SOX on companies operating in India. This is both a challenge and a huge opportunity. Today you take any mid-sized company, if an auditor wants to certify this, and again today no management can say, I have an internal audit so I am covered. Unacceptable argument. This particular clause, to get comfort, you will need to go into a phenomenal amount of detail. Now incidentally, the Directors Responsibility Statement also for listed companies requires internal financial controls to be done. But for non-listed companies, there is nothing in the Directors Responsibility Statement. But here in the audit report, you are required to say this. Now for doing this is essentially nothing but your SOX framework, and it's actually very simple. It will become necessary for organizations, for either the statutory auditors themselves as a separate engagement, or by other auditors working for the management, to build this control framework. And how you build this control framework, I'll just try and explain it to you in a minute or two before I sign off. You will have to itemize your entire company into certain components. Order to cash, procure to pay, treasury, investments, anything else that you may, statutory compliance. Now under each of these broad headings, you will have to identify components. And for each of these components, you will have to identify a process, identify the risk, for example, if my cash is a process for me, is a component for me, I have only 5 aspects in cash. Cash receipt, cash payment, cash balance, and cash holding, cash insurance, let's say, and cash physical verification. Today the New Companies Act, if you have to sign as an auditor, you have to be very clear that your internal financial controls are operating on these 5 aspects of cash. So for each of these there is a risk. Cash receipts may get lost. Cash receipts may be banked in a delayed fashion. There could be teaming and ladding on cash receipts. I have given you only 3 examples of risks on cash receipts. Now for each of these risks there will be a control. The company has in place then one more risk could be cash receipts are fraudulently printed. So this is another risk. So for each of these risks you will have to document the control. You will have to say, oh, this company has serial number receipts. The cash receipts are only issued by the cashier. Unused cash receipt books are in the custody of the cashier. So just for a cash cycle, there are 20-25 risks. And this is not how you do an internal audit. So this kind of a matrix approach to internal financial controls over financial reporting will possibly be the biggest throw-up of this act, in addition to litigation. I think this Companies Act is going to throw up a lot of opportunities for litigation, and I think both these spaces, in addition to your statutory audit, were the most well-equipped to handle. So with this, I'd like to conclude this formal part of my presentation, and should you have any specific questions which are not related to aspects such as forms, which I will do offline because I need to see the form, I'll be very happy to take. Thank you for this very patient listening.
Members, please be seated. There is an announcement for you for your lunch as well. And before that, I deem it as a great pleasure for having heard Sripriya taking us through in the 1.5 hours of how the whole Companies Act and what are all the aspects related to private companies. Few of them still are that about the CARO, whether it's how it's going to take form, whether it's going to be applicable after this new act has come in or not. And also one major threat which is there is class action suits, and that's going to be applicable for private companies as well, and the applicability of audit rotation and eligibility of 20 companies. All these are, I'm sure my good friend Joman George will take us through in the afternoon. And regarding the speaker today, I'm sure that you all appreciate that Sripriya ma'am took us through a very important aspects of the private companies. A round of applause for her, I'm sure. Friends, I also told that we had Sripriya who stands up and talks about various important things. We have another good friend of mine from Kochi, Mr. Joman George, a man with very high integrity, standing and knowledge. I'm sure we'll be hearing about that. Not just because they are here and I have invited them, but I find these people are of merit and they stand for issues. One such issue was, there was an issue of 21 lakhs which was due to Bangalore branch. Notwithstanding anything which will possibly be affecting them, both of them stood firm to ensure that this 21 lakhs will come to Bangalore branch. I acknowledge their contribution in ensuring the Bangalore gets its rightful due. And same is the case when it came to the accounts, when it is not giving a true and fair view. We find that people who are able to stand up and say, we dissent to an account which does not give a true and fair view. I'm sure they are carrying the same attribute in their professional pursuits as well. So these are the people who are here. And quickly, couple of things. Ma'am was telling about the share application money pending allotment and not being done. This is actually some things of the past, because once the act has come into place, it has talked about the monies which are lying as on 31st March also. On the 15th of June, if this is non-compliance, you might have already got notices, or if it is not done, you await the notices to come. That's again another opportunity for us to look at it, because this has been made clearly mandatory. Vanishing dormant companies, as per the Companies Act website says, 3.5 lakh companies are either dormant companies or vanishing companies. Out of total of 12.42 lakh companies which are there, only about 9.83 have filed the returns and things like that. Balance of them, there is no trace about it. And in terms of the transitionary provisions, 15 months is not the case. It's only 9 months from the end of the year, in which the new companies also have to do that. And these are all things which, while it throws out, I'm sure that these sort of programs which are there enable our members to understand that, and the speakers also get their knowledge enriched, as was told by the SYL speaker. And as far as the lunch is concerned, those, because of the place which is there, and to enable timely return back to the next session, which is equally interesting and important, which my good friend Ravi Prasad will be dealing on, the aspects of changes warranted in the guidance note, we would request those on the left aisle to possibly walk across to the institute branch at the top floor. You can have your lunch there. Those on the right aisle possibly can go to the basement here and have that. And before that, there's a very pleasant task for me to invite Mr. Devi Cherian, partner of Varma and Varma and Company, to come over and hand over the memento to Sripriya Kumar as a mark of our love and affection, and also for the services he is in rendering, and especially today delivering a lecture for all of us. Thank you very much, Mr. Cherian Baby, and thanks to the speaker, Sripriya Kumar, for her excellent delivery of today's session.